Have you ever wondered how construction companies make money? Today, we dive into the financial workings of these firms using real-life examples. You see, the construction business is a fascinating world of figures, contracts, and strategic partnerships. It's not just about erecting buildings or laying down roads. It's about meticulously planning and managing resources, negotiating contracts, and making strategic decisions that impact the bottom line. Just like any other business, construction companies make money by delivering a product or service at a cost that's lower than what the customer pays. But it's not as simple as it sounds. The cost of construction projects can be astronomical, and the risks are high. So, how do these companies navigate this complex landscape? Well, they employ a variety of strategies. Some form partnerships to share risks and resources. Others focus on niche markets where they can command higher prices. And then there are those that diversify their services to create additional revenue streams. In the next few minutes, we'll delve deeper into these strategies using real-life case studies. We'll see how these companies operate, how they tackle challenges, and how they turn risks into opportunities. So, buckle up as we embark on this enlightening journey into the world of construction business finances. Let's begin with a case from the international scene, involving French company Eramet and its lithium plant in Argentina. Eramet, a French mining group, partnered with Chinese steel group Tsingshan to launch a lithium production project in Argentina. This collaboration is a shining example of strategic partnerships in the construction industry. Eramet, which owns a vast lithium deposit in Argentina, found an opportunity to resume its development, previously halted due to the pandemic, through this partnership. The agreement between Eramet and Tsingshan involves constructing a lithium processing plant, a project that will see Tsingshan financing almost 94% of the $400 million investment. In return, Tsingshan will acquire a 49.9% stake in the project, while Eramet will retain a slight majority interest at 50.1%, along with operational management responsibility. The partners have set ambitious goals for the project. By the second half of 2025, they aim to achieve an annual production of 24,000 tons of lithium carbonate equivalent. This is not just a number on a strategy plan, it's a potential revenue stream that is estimated to generate $165 million in annual earnings before interest, tax, depreciation, and amortization once the production target is reached. But the strategy doesn't stop there. Eramet is currently in talks with European car manufacturers and battery makers for potential supply agreements. This move would ensure a steady demand for the lithium produced, thereby securing the project's profitability in the long run. Furthermore, Eramet may add more processing units in Argentina to fully utilize its substantial lithium reserves. This plan is in anticipation of the expected surge in global demand for lithium, primarily driven by the growing adoption of electric vehicles. Through this partnership, Eramet and Tsingshan have created a symbiotic relationship that benefits both parties financially. They've combined resources, shared risks, and maximized the potential of a dormant asset. This is a textbook example of how construction companies make money through strategic partnerships and investments. Now that we've seen how partnerships play a role in a construction company's finances, let's look at another example involving Tellurian Inc., an LNG developer. Tellurian Inc. plans to start the construction of its $16.8 billion Driftwood LNG export project in Louisiana. Now, you might ask, how does a construction company make money on such a colossal project? Let's delve into that. This project is a response to the escalating global demand for liquefied natural gas, or LNG. As countries shift away from coal-fired power generation, the need for LNG is on the rise. This trend presents a lucrative opportunity for construction companies like Tellurian Inc. The project's financial blueprint is designed with this global energy trend in mind. The company is investing heavily, yes, but it's also anticipating substantial returns. The recent surge in LNG prices and shipping fees due to cold weather in Asia and shipping bottlenecks has further amplified customer interest in the project. By investing in large-scale projects like Driftwood LNG, construction companies can reap significant profits. They leverage global energy trends, capitalize on the increasing demand, and turn it into a profitable venture. The first phase of Driftwood is projected to be operational by 2025, producing 16.5 million tons of LNG per annum. This production capacity translates into massive revenue, a testament to the profitable potential of such large-scale construction projects. On a different note, not all construction projects end up profitable. Let's examine the case of China's Evergrande Group. China's Evergrande Group, burdened with over $300 billion in liabilities, has seen many of its assets seized by creditors. This is the stark reality of what can happen when financial management goes awry in the construction business. Evergrande, once a titan in the industry, has been brought to its knees by the weight of its own debt. The chairman's lavish mansion in Hong Kong's prestigious Peak residential enclave, once a symbol of success, was seized by China Construction Bank. This was not an isolated event. Many of Evergrande's assets have been taken over by creditors, each one a nail in the coffin of the company's financial stability. This is more than just the downfall of a corporate giant. It's a cautionary tale for every construction company. It underscores the importance of prudent financial management and the potential risks of overextension. When financial obligations are not met, the consequences can be catastrophic. As we've seen, the financial workings of construction companies involve strategic partnerships, large-scale projects, and prudent financial management. Failure to properly manage finances can lead to dire consequences, as seen in the case of Evergrande.